Did you know that there's a legal loophole that allows high-income earners to put money into a Roth IRA, even if you make too much money to qualify? Well, it's called the Backdoor Roth IRA, and it could save you thousands in taxes over your lifetime. In today's video, here on Mask Money, I'll break down exactly what it is, how it works, and whether it's right for you. Welcome back to Mask Money, the channel where we talk about investing, personal finance, and building real financial freedom. If you want to learn how to grow and protect your wealth, make sure to hit subscribe and like this video. Here's the problem. Roth IRAs are one of the best retirement accounts out there, but the IRS puts income limits on them. In 2025, if you make over $161,000 single or $240,000 married filing jointly, you can't contribute directly to a Roth. But the loophole is this. There's no income limit on contributing to a traditional IRA, and there's no income limit on converting a traditional IRA into a Roth IRA. Put those two together, and you've got a backdoor Roth IRA. So here's a step-by-step process on how it typically works. You'll open both a traditional IRA and a Roth IRA, and you'll contribute to the traditional IRA. Then you just immediately convert that money into Roth dollars in your Roth IRA. Congratulations! You've just done a backdoor Roth IRA. That money is now in your Roth and can grow completely tax-free forever. This sounds simple, but there are some traps that you are going to need to avoid. There is no deduction for your traditional IRA contribution because it's after-tax money, so you don't claim a deduction on that. There is also the pro-rata rule, which is if you have any other pre-tax money in a traditional IRA, a SEP IRA, or simple IRA, the IRS looks at all of your IRAs together when you do the conversion. This can cause part of your conversion to be taxable. For example, if you already have $93,000 of pre-tax IRA money and you add $7,000 after tax, then convert that $7,000, most of that would actually be taxable because of this strange ratio. You'll also need to file Form 8606. This is an IRS form to track your non-deductible contributions and conversions. This is how you prove to the IRS that you've already paid taxes on the money. I will also mention that there is also the mega backdoor Roth, which uses after-tax contributions into a 401k or 403b to move tens of thousands of dollars into Roth every year. That's a more advanced strategy, and I'll cover that in a separate video, but just know it exists. So who actually needs the backdoor Roth IRA? High-income earners who make too much for direct Roth contributions, people who want to maximize tax-free growth in retirement, and professionals like doctors, tech workers, or anyone with a strong salary who still wants Roth exposure. If you're just starting out and your income is under the limits, you really don't need the backdoor strategy. You can contribute directly to a Roth IRA the normal way. So let's put some numbers to it. Imagine you start at the age of 18 and contribute the maximum of $7,000 every year through a backdoor Roth IRA until you retire at age 65. That's 47 years of contributions. If your investments grow at an average of 7% a year, by retirement, you'd have around $2.6 million. And because that money is all Roth, that full amount can be withdrawn completely tax-free in retirement. Compare that to investing in a taxable brokerage account where you pay taxes on dividends and capital gains along the way. Over decades, those taxes can really eat away at hundreds of thousands of dollars, and that's why the Roth category is so powerful. So to wrap up, the backdoor Roth IRA is a smart legal way to bypass Roth income limits and build tax-free wealth. Just make sure that you understand the pro-rata rule and file the right tax forms. This is Mask Money. If you found this helpful, hit the like button, subscribe, and let me know in the comments if you've ever used the backdoor Roth strategy. Thanks for watching, and I'll see you in my next video.